China is bucking the trend again, and they are injecting a ton of cash liquidity into their economy here at the same time as central banks all around the rest of the world are tightening. In fact, this is their biggest ever cash injection at 632 billion won. Now keep in mind, this comes at a time when the rest of the world is tightening and trying to withdraw liquidity, but this is not the first time that China has gone against the grain and done something different than what the rest of the world was doing as far as monetary policy is concerned. If you remember back in 2020, when the rest of the world was easing like crazy and just printing trillions and trillions of dollars, China was one of the only ones who was actually holding back and was trying to not ease. And in fact, they actually started to tighten when everybody else was still easing. Everybody remembers the Evergrande collapse that started in China in 2021 as a result of China clamping down and getting tougher on the easy property markets there. But now, as the rest of the world is tightening and trying to fight inflation, China's problems have gotten too big for them to bear, and they've started to go against the grain again and inject new money into their system. There's been a squeeze in bank borrowing costs there, and so they're trying to solve that by injecting a record amount of cash. This was after interbank funding costs soared to the highest level they were in 2 years last week. So how exactly are they injecting this liquidity? They're not just printing the cash and handing it out to people like helicopter money. This is through the reverse repo market there. You all are mostly familiar with the reverse repo market here, but essentially there it operates the same way. In between banks, there's interbank lending. That means if one bank needs cash, they can go to another bank and say, hey, can you lend that cash to me? And we'll reverse that transaction at some point in the future. Well, when cash gets really tight, banks don't have the ability to lend that cash out to other banks. And so the rate at which that cash is lent out goes up. And that's exactly what happened here. Interbank funding costs recently soared to the highest level they were in China in 2 years. So in order to combat this and make sure that that liquidity crunch is solved, to make sure that there's no banking crisis and banks have all the funding they need, People's Bank of China injected liquidity directly into this market, just like the Fed has been doing for a couple years. But there's a problem with this. Anytime you have a bunch of different fiat currencies, their values are going to be determined only by the relative value of that currency compared to the other fiat currencies. This is why when the dollar goes up and down, it's really not a good indication of the purchasing power of the dollar changing. The value of the dollar as measured by the DXY, the dollar index, is simply a measure of the dollar versus a basket of other currencies. This presents a problem for China because they cannot ease to the extent they might want to, given the fact that it will weaken their currency relative to other currencies like the dollar. This is exactly what has happened to the Japanese yen over the past few years, as they have continued to ease, but that has weakened their currency relative to other currencies like the dollar. But that still did not prevent them from engaging in the largest liquidity injection that they have done to date in order to save their interbank funding markets. First, I'd like to tell you about today's sponsor, I Trust Capital. Today, people are concerned about the purchasing power of their dollars being eroded due to inflation. They're concerned about the returns they're getting on their traditional portfolios, things like stocks and bonds. Many people want to be able to purchase investments that will preserve their purchasing power, things like gold, silver, Bitcoin, ways to store the value of your money without being exposed to the dollar. What's the problem with this? The problem is that most people have most of their wealth in their 401ks, their employer's retirement accounts. And these accounts do not allow people to buy gold, silver, or Bitcoin. Some of them allow access to ETFs that have exposure to these prices. But number one, you're introducing many layers of counterparty risk. And number two, you don't actually own the asset itself. That's where I Trust Capital comes in. I Trust Capital allows you to open up actual retirement accounts, IRAs, traditional and Roth. You can even roll over funds from a previous employer's retirement account to fund this. You can buy gold, you can buy silver, you can buy Bitcoin and even other cryptocurrencies with I Trust Capital. And if you sign up with my link in the description below, you'll get $100 worth of Bitcoin as a sign-up bonus for opening the account. When you have a system that is built on debt, the only way to resolve that is to continue to print money, because you cannot repay that debt with the same amount of purchasing power that was borrowed. So if you want to avoid a complete crash and a long period of heavy deflation, then the only way to avoid that is through inflation. You have to print more money to pay back that debt in money terms, even though the purchasing power is a lot less. It's technical default. And this exact problem, while it's happening in China, is also being faced by America, countries all over the West. This is not isolated to economies like China. This is a global problem. In China's case, they have somewhere close to 6 trillion yuan of notes that are due by the end of March, and this is an all-time high. And even though they did this massive injection, the rates for interbank borrowing are still rising. Now, this will make many people question the de-dollarization narrative and whether the dollar will get weaker going forward or stronger going forward, given the problems that China is facing and many other countries around the world are facing. But I think that's looking at this from the wrong point of view. Why would you be trying to find the cleanest shirt in the dirty laundry hamper when you can just wear a clean shirt off the rack that's actually clean? You're not limited to the choices in the hamper. In any case, it looks like if the People's Bank of China does not engage in a larger scale easing methods, such as lowering interest rates or reducing the required reserve ratio, it's going to have to inject larger and more frequent amounts of liquidity into these short-term markets going forward. Whether you are a nation, a corporation, or an individual, there's no such thing as a levering up without a following deleveraging. Now, a deleveraging can occur multiple ways. You can either deleverage through inflation or you can deleverage through deflation. From a personal standpoint, an individual finance standpoint, think of it this way. If you are going to lever up, that means taking on debt. So you want to spend more money than you make this month, so you use a credit card. In order to pay that back, next month you're going to have to spend less. So you make 10 grand this month, but you spend 11 grand. That means next month you have to pay back that $1,000. Next month you can only spend 9 grand so that you have $1,000 left over in order to pay back that debt. That is deleveraging through deflation. Less money to go around because you already spent that future money in the past. That's what debt is. It's borrowing purchasing power from the future, pulling it forward to the present, and spending it now. It's already been spent. It doesn't exist in the future anymore. So that's one way to deleverage, through deflation, austerity, spending less in order to pay it back. But there's another way to deleverage, and that's through inflation, and that's through having more money. Now, from an individual standpoint, the easiest way to think of this is through increasing your income. So you make 10 grand this month, but you spend 11 grand. That extra $1,000 is on a credit card. Next month, you actually get a raise. And so you make 12 grand and use one of those extra $1,000 to pay back your credit card. So there's more money. You're able to deleverage and get rid of that leverage through inflation, through more money. Now, this highlights a little bit of a distinction between how individuals might do it and how a state might do it, because individuals don't have the ability to print money into thin air or out of thin air into existence. And so in the individual's case, what you're actually doing is deleveraging without experiencing any pain of doing so, because you actually increased your productive output. And this is how the rich do this. They lever up and they use that debt to buy assets that cash flow in excess of the debt service costs. And then they've used that debt to become more productive. And so they're able to deleverage then as a result of the extra income they have from those assets they purchased with that debt. So instead of just relying on a pay raise to hopefully let you pay back your credit card in the future, you use that debt instead to consume something to produce more wealth or buy assets that produce wealth, and then use the additional income to deleverage. But states obviously are going to be a little bit different. They're going to default to printing when they can, and they're going to still deleverage, but they're going to do so through inflation. They're going to print more money and pay that back. But since printing money causes prices to go up, basically basically you're just taking purchasing power from all the other dollars that are already in existence, using that to deleverage. And so when you have an inflationary deleveraging, you still have all the pain of it costing more. You can't get the same amount of stuff as you would for deflation. The only difference is that it looks like prices going up instead of prices going down, but the experience is the same. It's harder and more difficult to get your hands on real wealth. Now, overall economies, for the last note, can also deleverage either through inflation or deflation without experiencing the pain of that, as long as you increase productive output enough to offset the pain of the deleveraging. This can be done through increased immigration, through more workers, through artificially intelligent robots, through half the population, like women, joining the workforce, through agricultural or industrial or technological revolutions. All of these things are examples of massive increases in productive output that helped the system deleverage, inflationary or deflationary, without experiencing the pain of doing so because the productive output increased so much faster. But given what China is doing right now with injecting their liquidity, it does not look like they are wanting to bank on a massive increase in productive output. Does not look like they have the system able to support that. So as of right now, looks like they're going to be heading towards an inflationary deleveraging. As always, really appreciate you guys. Thank you so much for watching. Have a great day.